Alphabet Inc., otherwise known as Google, has just released their third quarter earnings results for 2024. We're just going to quickly go through this right now and then see if it is a buy using these latest numbers on my discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. We'll see if Google is a buy or a sell based off these numbers. The stock has gone up around about 4% in after hours due to this news, so the market does look like they're liking what they're seeing. So consolidated Alphabet revenues have increased 15%. It's year over year 80.8 billion. Google service revenues increased 13% to 76 billion. Google Cloud increased to 11 billion. Total operating income increased 34%, and net income increased 34%. So we do have the numbers here. This is 23, this is 24. So you can see, as we saw, revenue up 88.2 billion compared to the 76. So that is up massively. Net income as well, 26 billion compared to 19.6. Diluted earnings per share, $2.12 compared to $1.55. We can see some of the breakdowns here. Google Search up to 49, YouTube ads up to 9, network down slightly actually, but Google advertising in general up to 65 billion. Google subscriptions 10. This means that they have the total of 76 billion up from 67, Cloud 11.3 compared to 8, and the total revenues, as we said before, 88.2 to 76. We do have free cash flow a little bit further down. Where is it? We'll have it down here in the... Well, I did search for it before, actually. I just searched for it. Free cash flow is 17 billion. So everything is looking pretty good. So what we'll do is we will look at my automated stock valuation spreadsheet. We will put in the ticker GOOG, and then we will add in these latest numbers that we've just seen. So for revenue, it is 88,268, and you can see here the total revenue in the trailing months has increased there. It went from 326 to I can't type 326 to something slightly higher, because obviously we've just added these numbers up right now. So this is just going to reload here because I clicked back a few times, but we'll just let this load and we will continue with it. Although actually net income was 26,301, and we finally have free cash flow at about free cash flow on my other screen is 17.637. So you can see that actually down slightly to 55, but let's have a look at the revenues. So no surprise there. Trailing 12 months, 338 billion all-time highs. Net income, all-time highs again, 94. Free cash flow, probably see this down a little bit, down to 55 billion. Let's see if I can get the... okay, there you go. So if I go back to the earnings, you can see net cash is 30.6 and CapEx is 13. So unfortunately, I can't compare these fully, but basically you can see here that CapEx has been increasing and operating activities has as well. So let's get into the automated stock valuation spreadsheet. This is the discounted free cash flow model. It's a way of valuing companies, looking at the future free cash flows, discounting them to today's value. So this currently gives us a price of $108 a share. Let's see if we agree with these numbers. So revenues, we're estimating 375 billion and 417. If we compare to what analysts are saying, they are saying that Google's revenues are 341. Okay, so we're a little bit on the more bullish side. They are expecting around about 20% growth per annum for the next 5 years. So we'll leave that as it is. Net income margins are increasing. I suppose we'll expect these to increase. So we'll do 29. That brings it to 128. And yeah, we can see these are down. So we're going to take an average of these 3 years to bring it up slightly to 73%. So discounted free cash flow says it isn't actually a buy at 144. Quite interesting. So let's have a look at the Ben Graham formula for intrinsic value. This looks at earnings per share, AAA bond yield, corporate bond yield, and the current values of this are 4.68%. And I believe we said it was around about 20%. And that is a buy, $188 a share, currently 177. in after hours. So Ben Graham does think the stock is a buy. Let me just double check and see if we have a more exact value here. Down here we have, 20.62. But if they did grow as their previous 5 years, it would be a $220 stock. So discount free cash flow thinks it's a bit overvalued. Ben Graham seems to like it. So finally, we will look at the comparable company model. This is a way of valuing companies, looking at similar companies of similar size and industries. So let's go with Microsoft. That I think is a pretty good example. Also, if you're interested in this, please check my Patreon. Links are in the description. We will also go with, I suppose, Apple. It would be good if we could just compare the AWS, but we can't. So we'll go Microsoft, Apple, and Meta as well. All very similar companies. Apple obviously the largest, 3.5 billion, then Microsoft, then Google, and I believe Meta after that with 1.4. Google, actually, unfortunately, this doesn't look at the latest numbers, but we know that the revenue here is actually 338. So, oh no, it does automate it. What a great sheet by me I've created. Please check out the Patreon. So second highest revenue, only below Apple. Second highest growth rate, only below Facebook. EBITDA, third highest. Net income, second most profitable. Okay, well, all these profit margins are excellent. Microsoft 1, then Meta, then Google, then Apple. Price to sales, this is actually the lowest. I think the market is around about 3, so that is quite good. Price to book, it is the lowest as well, with I believe the market average is around about 5.11, yep. And second lowest peg, which is the price to earnings growth, only Meta is lower, which is 0.97. This is Peter Lynch's price to earning growth. So now the metrics we're looking at here are EV to revenue, EV to EBITDA, earnings before interest, taxes, depreciation, and amortization, PE, and forward PE. So we can see that Google does have the lowest PE and forward PE. Ignore the fact that's where I need to fix this, but all of the comparable company models saying this is a buy. 250 to 200, giving an implied average of $230 a share. So that is pretty good. So far, I think that the models do say it is a buy. Let's just see if we have anything else in here in the earnings that we do want to discuss. The momentum across our company is extraordinary. Our commitment to innovation, as well as a long-term and focused investment in AI, paying off with customers, partners, benefiting from our AI tools. I mean, I've used a bit of Google AI tools. I think they do actually have it on everything, which I don't know if I do like, but if you see here, if I type in Google, it's not doing it now, but they do normally put it in there. But earnings have been good. If we were to compare Google versus the S&P 500 over some recent times, you'll probably see that it is beating the market yet again. So what we do is just put in SPY. We'll do year to date. Pretty neck and neck actually. Market winning slightly. Over last year, market's winning slightly. Wow, wasn't expecting that. But over the last 5 years, 170% compared to the 130. So Google probably had a bit of a discount right now, and everyone sort of liking the stock, as well as the models also liking the stock. 4% now to $179 a share. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check my Patreon, and I'll catch you guys next time.